This is Market Pulse, part of the Faster Forward podcast series from Northern Trust Asset Servicing, where experts share their insights on current trends in the markets and financial landscape. My name is Grant Johnsey, Head of Client Solutions at Banking and Markets Americas at Northern Trust. I'm super excited about hosting today because joining me is Jonathan Brodsky, the founder and co-PM of Cedar Street Asset Management. John is not only a good personal friend, but he's also a longtime client. And John's someone that I look to for insights in global markets. So today we're going to dive into a wide range of topics, including AI, tariffs, China, global small caps. Please note that nothing discussed today should be construed as a recommendation. We'll likely discuss some individual stocks, but only to illustrate points and provide examples. Jonathan, thanks for being here today. I really appreciate you joining. I'm really excited about this. You've got a varied background. You're a lawyer at the SEC, an investment banker. How did you get into asset management and managing money?
Yeah, so I think that my career is an example of a non-linear path into the place where I am now, the founder of a boutique asset management firm. I think it all starts from my academic interest. When I was growing up, I was very interested in languages and cross-cultural differences. And actually, my first job was working for a PR firm in mainland China in the early 90s. It was a lot different in those days than it is now, but it was very exciting. And I think I wanted to continue down that path. I had a master's degree in international relations and kind of focused my career on geopolitical components, as well as just the differences of people around the world. That was what was interesting to me. And luckily, through the years, I navigated a career path that allowed me to end up doing what I'm doing, which is managing money for institutions, foundations, high net worth individuals, and retail investors, focusing on non-domestic equities and focusing specifically on small cap non-domestic equities. I think the pathway to the job where I am now was really assisted by my work at the SEC, where I was an attorney and a consultant in the International Affairs Office. And that was a key determinant in terms of my knowledge on corporate governance, my knowledge on market structures, and how all these different exchanges cooperated and had differences. And that really helped me get my initial job in the asset management industry at a firm in Chicago by the name of Advisory Research. And from there, after almost 15 years, I started up Cedar Street Asset Management as an entrepreneurial boutique endeavor.
So tell us a little bit more about the strategies that you specifically manage right now.
Yeah, so we are strong believers in the inefficiencies of certain asset classes within the market. And as you look historically and as you look at the academic research, the more you move down market cap into the smaller cap realm, the more inefficient the markets become. And obviously in my markets where you have different language, different cultures, different exchange structures, those inefficiencies can manifest themselves even more. So we really focus on one specific area, and that's investing capital in the non-US markets in the small cap value realm. And if you look at academic research, this is one of the most productive parts of the market, primarily because of the inefficiencies that we're able to find.
So launching a asset management company in this environment is very difficult.
Yeah.
We were fortunate that you were our very first outsourced trading client 9 years ago as we launched our outsourced trading business. So I've gotten to watch your growth and some of the success that you have had. Walk me through, what were your decisions as you launched an asset management business and endeavor in this environment? What were some of the strategies and your thoughts as to how to build a going concern in what's been a very difficult environment?
So I think our relationship with Northern Trust was, an important element of my being able to get the business off the ground. What we wanted to do when we started Cedar Street Asset Management was use the best in technology to create efficiencies, to create a cost structure that could support a boutique and independent firm. A lot of people look at the current terrain and say independent small firms would have a very difficult time from a cost perspective to be able to manage the disparate requirements of what's necessary as an SEC filer in the current regulatory regime. But interestingly, if you use technology and you use platforms, mostly on an outsourced service like we have with Northern, it really gives you the opportunity to have the best of both worlds, very efficient, cost productive infrastructure that allows us to focus on what we want to focus on, and that's portfolio management and selecting stocks for our clients.
It is pretty amazing. I've watched you build your team over the years. I mean, you've got some very specialist analysts that are experts in the fields that they have. And these are some fairly esoteric asset classes where you can really build alpha in some of these small cap and some of these emerging market outside the U.S. It's been fascinating to watch that.
Yeah, I think it's a purpose-built type of a structure. I think when people are investing in the types of markets and the types of companies that we're investing in, having local knowledge, having someone who's a language speaker that understands the culture is extremely important. The nuances of being in these markets is not easy. It's one of the reasons why we're trusted with capital to go into these markets, given our expertise and the way the team is structured. And I think when we started the business, it was purpose-built specifically to have those types of folks on the team so that we can feel very comfortable with the research that we're doing and the selections that we make.
And so the ability to really focus more of your internal investment on the portfolio construction side comes part and parcel with not having the traditional overhead and cost structure that some of these legacy asset management firms have. Is that kind of how you've been able to really build a strong alpha product and portfolios?
I think that it's a very important component of the overall nature of a boutique entrepreneurial investment management firm in the current era. From the standpoint of when we started, new technology had been coming on stream that allowed very efficient operations from an outsourced perspective that really didn't exist, prior to that. And so in a lot of ways, being able to start de novo, being able to start from scratch was a big advantage for us. And I think as we've discussed that through the years, obviously we get a lot of questions of how do you manage all these different markets? How do you manage the complexity of the work that you do? I'll give you an example. To get access to India, if you want to trade directly in India, the process of applying for a license to trade is extremely laborious. It can take many, many months to get that type of a license. So you're dealing with a lot of different complexities in terms of the markets that we operate in, but we're actually really well suited to handle those complexities in a very efficient and non-bureaucratic way. So I think that there are actually some real distinctive advantages of starting the business when we did start the business in terms of these technological offerings.
Yeah, it's interesting. So let's dive into small caps and non-U.S. small caps in particular, which is one of your areas of expertise. I mean, these are two asset classes that, non-U.S. equities and small caps have not been in particular favor. How should investors think about non-U.S. small caps right now? How do they fit into the portfolio?
So the first thing that we like to talk about in terms of what we do outside the U.S. and non-U.S. small cap value is understanding the building block methodology of asset allocation. So first and foremost, diversification is an investor's best friend. And if you look at the diversification opportunities that are out there, and you look at the correlations of returns, non-U.S. small cap and non-U.S. small cap value offer distinctive diversification benefits. That's number one. But number two, if you look historically at performance, investing outside the U.S. and non-U.S. small cap value stocks has historically been a very productive way of allocating that type of capital. The reason is that oftentimes the valuations are depressed because of misunderstanding of these names or lack of sell-side research coverage. So the inefficiencies provide potential opportunity for alpha. And we like to talk about if you're going to allocate money outside the U.S., where's the most productive way of doing it? The larger cap you go, the more correlated those equities tend to be to U.S. large caps, which makes sense. For example, a McDonald's is going to be generating 40% of its returns outside the U.S., just like a BP or a large financial institution in Europe or in Japan would likely be getting a lot of its revenue from macroeconomic forces or from overseas operations. So if you really want to diversify, one of the best ways to do it is to get more localized exposure. And that's what we do with non-U.S. small cap equities.
That's interesting. What about the U.S. dollar? I mean, we've seen such a strong U.S. dollar, particularly the last couple of years. That's got to be one of the bigger challenges a non-U.S. equity portfolio faces. What's your views on the dollar? How has that had an impact on your returns?
Yeah, so when we invest capital for our clients, we're taking U.S. dollar-based investments into our vehicles, and then we're converting that and buying local shares in local currency. So currency movement is an element of what the return stream looks like. In general, the view is from a diversification perspective to have foreign currency exposure will allow for additional diversification. And sometimes the dollar is strong, sometimes the dollar is weak. But at the end of the day, that diversification stream is what a lot of folks are looking for. Now, over the last couple of years, the dollar has been perpetually very strong. And what that means is for our clients, the returns are lower because the dollar has strengthened. Historically, what happens when the dollar strengthens is the earnings productivity of the overseas companies goes up because they're able to generate some of their earnings in dollars. Interestingly, the multiples have not moved as the dollar has strengthened. And that's been a headwind for our returns and has been a headwind for the overall performance of non-US small cap equities. We think over time that there'll be more of an equilibrium, and that that headwind will be at least neutralized or could potentially turn into a tailwind.
Are there any other challenges that you're facing right now or that you're looking at as it relates to the portfolios that you manage?
I think that over the last few years, it's well documented that U.S. equities have outperformed or even dramatically outperformed non-U.S. equities. One of the components of that outperformance is what we just discussed, and that's dollar-based returns. So a lot of folks, when they look at their returns of their non-U.S. equities, they're not adjusting for what's happened with the currency. So that's element number one. But element number two, because the U.S. economy has done quite well and some of the markets that we're in have not done quite as well, you've seen much more investment fervor and enthusiasm for U.S. equities, and that's driven multiples upwards. Whereas in our markets, the multiples have actually either stayed kind of consistent or they've actually decreased. What that means is these companies have been productive, but the valuation support has not been there because enthusiasm has been relatively low. And so what that means for us is when we're talking to our clients or we're talking to our potential clients to understand the dynamic of, these are not companies that are not performing well. It's that the environment has not been very favorable, and therefore the multiples have actually contracted. One of the easier ways to look at that would be what's the dividend yield of the strategies and what's the return on equity of the strategies. And if you look at it purely on that basis, these are very productive companies delivering high levels of dividends, partially because they're operating well, but also partially because the dividend yield is high due to the price compression.
Interesting. Well, let's talk about tariffs, because that's potentially another headwind. And I know there's a lot of unknowns in tariffs still, but there's probably going to be at least some additional tariffs that come out of some of the saber rattling happening from the Trump administration. How do tariffs impact your portfolio? How are you thinking about tariffs and the way you manage money right now?
So the advantage, again, of small cap non-U.S. equities is that they tend to be quite localized. And so this tariff issue tends to be less of a problem for them. Number one. But number two, they also happen usually to operate in multiple geographies. So I like to give the example of the Taiwanese company that makes some kind of technological component. Well, they're not only manufacturing that in Taiwan, they're not only manufacturing that in China, they're also probably manufacturing that in Southeast Asia. They could even be manufacturing it in Mexico. They tend to go to where their clients need them to be and have the optionality of producing components or materials for the companies in the markets where the tariffs are more muted. And we're beginning to see that play out to a certain degree where the larger buyer of the component or the element is saying, listen, I need you to move the production to a certain location. And we're often invested in companies that can be responsive to that.
Interesting. What about AI? I mean, most investors look at the U.S. and particularly the Mag 7 as being the place you need to be to get AI exposure. Are you able to get any AI exposure, or is that a part of your strategy right now in the portfolios you manage?
So we have significant AI exposure and opportunities in the markets where we operate. And that's because a lot of the underlying supply chain associated with NVIDIA is coming out of markets like Japan. It's coming out of markets like Taiwan, Singapore, and even China in terms of the component manufacturing.
John, in addition to AI, what about climate change? Is there any way that plays into your portfolio? Are you thinking about that at all in portfolios?
Yeah. I think environment is one of the mega trends that we're focusing on. Electrification, better quality food. There's many examples of kind of education is another one where we have underlying components of megatrends that we're focusing on. I think environmental considerations is one that we do have access to and that we think is extremely interesting. A simple name that I always like to talk about as it relates to climate change is we own a company in Japan by the name of Raito Kogyo, and this is one of the leading providers of services around landslide management and other type of environmental disasters, which unfortunately happen, especially along the lines of climate change. So you think about areas of the world that have large cliffs or mountains where things can landslide onto highways, as an example. Well, this is one of the leading providers of that service. It's located in Japan, but it's got a budding business around the world. Obviously, given the geographic considerations of Japan, that's an expertise that they have. So we're very enthusiastic about taking those types of ideas and expanding them and seeing what we can find within our valuation criteria. But I do want to caveat all discussions about our names in the context of we're disciplined value investors. So we're not looking at a theme from a top-down perspective. We're looking at the universe of opportunities, what fits our criteria as investors, and then what themes do we have as an overlay to the opportunity that the underlying company presents.
So what are the other megatrends? I mean, you mentioned megatrends. What else are you looking at? How are you thinking about the megatrends in your...
Well, I think electrification falls somewhat in the lines of environmental, but also products that are very productive as well. So we look around the world for different types of opportunities that are focused within that type of a trend. And so we own a number of names that are analog device manufacturers or they're sensor manufacturers. And you can find those in Europe. You can also find those in Japan, Taiwan, and other locations that focus on, for example, Grant, when you get in your car now, you'll notice, the different ways that you can see where the car is going from a sensor or an optical perspective. A lot of those types of components are actually being manufactured in the markets where we focus our attention. So as I said, when you get into a car, think about all the different components that go into that and where are they coming from. Oftentimes they'll be from Japan, they'll be from Taiwan, Korea is another example.
Jonathan, one of the things that I'm always amazed about in working with you for the last 9 years is how the names that you buy and invest in are names that I don't think I've ever heard of. Can you kind of walk through, kind of how you think about and how you find names? And, the one that always jumps out is how you made that investment some years ago in Acushnet, for example. Maybe use that as the example.
Yeah, that's a good example. So that goes back many years when we first met. Again, our approach in terms of isolating this broad universe of names, there's about 5,000 stocks in our universe, which is a lot, is to really focus on valuation components. What are we looking for in terms of the attractiveness of the investment relative to its valuation? So for us, it's taking a look at the screens or looking at different sources of ideas. And first and foremost, does the idea fit our valuation criteria? If it does, then we move on to a more expansive analysis of the opportunity from a productivity perspective, from a Porter 5 Forces perspective, from a market growth perspective. And in doing so, we think we can take inventory that is probably a little bit misunderstood or not understood at all, and create a investment thesis that we think will work out over time. Interestingly, you brought up the Acushnet opportunity, which resonates with a lot of folks, and it's something that we do talk about because a lot of people play golf, and it's a golf-related name. And I think it's a good example of this process. So many years ago, we invested in a company called Fila Korea. Now, most folks remember the Fila brand and think of it as an Italian company. Interestingly, that Italian company went through a myriad of restructuring, and the Korean licensee actually bought the whole business. So Fila as a brand was actually a Korean company. And when we found the company in the screens, obviously it looked interesting from a metrics perspective. Something very interesting was happening inside the company from a analytical perspective, and that was an associate level income element was driving a lot of the gains. And anyone who's in the accounting business or in the investment management business can know that these below the line opportunities can often yield some interesting results. So we know we have an associate that's doing something very interesting as it relates to the parent company. And we do some research and we find out that, lo and behold, Fila Korea, which has an okay apparel business, and we tend to not invest in a lot of apparel businesses, actually is the majority owner of another company that's called Acushnet. And Acushnet is a brand that is probably, well known to many people who are listening in this audience.
FootJoy.
It's Titleist and FootJoy, et cetera. And that had come out of a private equity transaction where the Korean business had bought the majority stake in the company. And we saw a really interesting development happening in terms of the restructuring efforts and the reorganization efforts within Acushnet that we thought over time would be worth more than the entire market value of the Fila Korea main listed business that was in Korea. At that time, there was very limited English language disclosure about this business. So unless you knew that Acushnet was an affiliate of Fila Korea, you wouldn't realize that. And so we spent a lot of time doing the research on it and discussing it with the company in the belief that at some point they would list that business, and that would unlock considerable value in the process. And ultimately, that is what happened. So you can now buy Acushnet on a publicly traded exchange in the U.S. That spinoff actually happened from this original Korean stock.
So this example is relevant because it's an area where you drove a lot of alpha, but the only way to know that was to do that deep digging of research, kind of follow that breadcrumb trail. But interestingly, it sounds like you had to know Korean.
Yep.
You had to have a Korean language analyst that was looking for that and saw that value through that subsidiary of the field parent company.
I think one of the challenges of being in the markets where we operate, but one of the opportunities is it's not all produced in English.
Yeah.
And so the service that we bring to our clients in that regard is we have the language capabilities of doing this type of research. And from that, they can expand and diversify their underlying portfolios, as we discussed about early on in the conversation.
Oh, that's interesting. Let's go into just a couple of markets. I like to start with China. I mean, you lived there for a long time. I know it's been a while, but you've traveled a lot since you lived there back to China. How investable is China right now? Do you have investments in China? What's your overall thinking and approach to investing in Chinese equities?
Yeah, so we don't have any direct investments on the mainland exchanges in China. We do have investments in Hong Kong, and we also have investments in what are called southbound securities. Those are mainland securities that are traded in Hong Kong. And our view on this, it depends very much in terms of what strategy we're investing in. But if Hong Kong is in like for a developed market strategy, for example, usually we're looking for very high quality, often multinational businesses. So an example of a company that we own in that market is one of the leading aviation leasing businesses. It's a global business. It's supported by one of the banks in China. So very interesting financing tool for them, where financing and your cost of funds is a very important part of your productivity relative to your competitors. So that would be an example, but things pop up all the time. I mean, we look at that market no differently than we look at any market around the world in terms of what's the valuation and what's the quality of these businesses. I think the idea that the geopolitical element of China versus another market, for example, we've heard through the last 12 to 18 months that, is China even an investable market like you talked about? We often respond to that by saying, if you're concerned about the investability of China, think about your U.S. equity investments that have significant exposure to those markets, which include Apple and Tesla and many other very mega cap names that have meaningful exposure to that market. So I think it goes a little bit both ways, and it takes an analytical approach to say, the risk reward here does look positive. We've seen some important changes within the corporate governance realm within both Hong Kong and mainland China in terms of higher demands on productivity and disclosure from the companies, resulting in potentially higher returns and higher dividend yields. And that's something that we would bring to the attention of investors about some structural opportunities that are happening in that market that maybe they don't know about.
Interesting.
Korea is another example where we see some meaningful and interesting corporate governance developments, something that's called the quote unquote value up scheme. And that is really the Korean government looking at the structure of the Korean equity markets and saying there's a lot of room for improvement here so that we can deliver better returns for our investors and our population over time, given some areas of what I would call weakness within the corporate governance structure in that market.
So it's a net positive then for Korea and Korean equities.
Most certainly.
Interesting. One more country I'm really curious your input on is India. It's been a white hot market, obviously great returns in the last year. Do you have investments in India? How are you thinking about that market given the higher multiples from the stock run up that we have seen in the Indian market?
Yeah. So one thing we obviously monitor from the perspective of a bottoms up analysis about individual companies is what kind of inventory is there that fits our criteria. And I think anyone who's following India will recognize that it's been, as you said, it's been an area of real focus over the last few years because of high GDP growth within that market. Interestingly, from an academic perspective, if anyone wants to take a look, GDP growth and stock market performance is not correlated. So that's something we do talk to our clients about, and that's another discussion on why that's the case. But I think with India, you have a very compelling structural argument around that market. The issue that we face within India is the valuations and the multiples reflect that dynamic kind of macro view on the underlying economy and the underlying country. And that generally brings us pause. The other thing that we pay very close attention to is kind of retail engagement within that market. And India is seeing massive flows of retail investors into the local market. That's partially driven by the very good returns that have happened throughout the last few years. So all that really, from our perspective, gives us caution in terms of how we would allocate capital to that market. That being said, we do have a few investments in India. They tend to be more infrastructure related or kind of macro growth related, a little bit more under the radar screen. For example, we own one of the largest telecommunication tower companies. We also own a company that imports natural gas. They have the actual natural gas import facilities, as well as a security services company. Because as countries get wealthier, they have more things that they need to secure that they didn't have to previously. But again, these kind of fall a little bit below the radar screen and they fit our investment criteria. But I think from an overall perspective, when you see the kind of the multiples that you have in India right now, I think that reflects enthusiasm that as a value investor we would be cautious about.
So my last question is, and this is an open-ended question, one of the things that we try to deliver in our Market Pulse podcast is insights and thoughts that are not necessarily on the front page of financial media and that our listeners and our audience might not be aware of. Is there anything that you can think of as you think across emerging markets and small caps globally and developed markets that you and your team, Waldemar, your co-PM, and your analysts are starting to think about and that's worth bringing up before we end today's episode?
Yeah, one thing that we're talking through with our clients and our prospective clients is exactly kind of how we started the conversation, and that is around the idea that U.S. equities have been so productive and have been so value added for portfolios, and non-U.S. equities and non-U.S. small cap equities over the last few years just haven't been able to compete from a return perspective. Why is that the case? And we go into great detail from an analytical perspective to kind of break down the components of returns. And what we like to talk about when you look at that, the analytics of it is, why is there this disparity? Is it a productivity discussion? Oftentimes in the news, it's about, U.S. equities have done better and traded higher multiples because they're much more productive. And what our analysis indicates is there's an element of that being the case, but that's not the primary element. The primary element of outperformance is really around multiple expansion and dollar strength. And so what that means is that productivity delta is not meaningful enough to overcome the multiple delta that has occurred. So what does that mean from the perspective of asset allocation, especially given the conditions that we're in as it stands, where the dollar is, really at one of its all-time highs in history. Yep. So if you have multiple expansion and you have dollar strength, and you have underperformance, is that, potentially an interesting time to reallocate or rebalance to a certain degree? Because there isn't really a lot of evidence that indicates that these companies are that much less productive. The primary driver has been the multiple expansion. And so, really distilling that data down into a productive discussion with our clients is our focus right now. And, we see people paying attention to that.
Yeah, you're on a roll right now, bringing in new capital. It's great to see.
Yeah, thank you.
This is incredible. I could sit here all day and ask you more questions, but we're out of time. So Jonathan, thank you so much for joining today and for being our guest. And thank you as well to our listeners for tuning in to Market Pulse by Faster Forward.